Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Eric Lutton. He is the CIO of Sound Income Strategies. We are talking about their fixed income ETF, ticker FXED. They're solving a problem in the market where there's a lack of fixed income ETFs that combine traditional bonds with higher yielding alternatives like BDCs, REITs, preferred, some other non-core bond ETFs. The end result is a little bit more yield as well as, a little bit more risk, but it's really geared towards retirees looking for income. But I'll let Eric explain how the product works. So without further ado, please welcome Mr. Eric Lutton. Hey, Eric, welcome to the show.
Thank you for having me.
So before we get started, why don't you give everybody a little bit about your background and how you ended up in your role over at Sound Income Strategies?
Sure. Well, I kind of started off after school studying finance, and I moved to Chicago to trade and work on the Chicago Board Options Exchange. So that's why I was introduced to derivative instruments and kind of a fast-paced crowd. First time I ever saw grown men actually throw punches at each other was in the pits of Chicago. After that, I had an opportunity to move closer to back home to Indianapolis and worked at a big insurance company on the money management side, Conseco Capital Management. So we managed about $36 billion at the time. This was back in the late 90s. Insurance company money, Taft-Hartley endowment foundation money, a lot of pension fund money. That's where I kind of was introduced to fixed income. Deep dives of evaluating companies, going through the Ks and the Qs, getting on management calls. Great opportunity. But I always knew someday I probably wanted to move to a warmer climate after, some Chicago winters that kind of did me in. So I had an opportunity to work at an RIA/hedge fund down in South Florida. Took the opportunity. It was great. So I've had a few positions down here, private bank running their fixed income and helping out with equities, and then an RIA with hedge fund, and then actually did a stint on the sell side after '08. Helping RIAs out with their fixed income needs. So building portfolios, selling bonds, trading bonds for them. And a little over 10 years ago, a mutual friend put me in contact with Dave Strand, who's the principal of Sound Income Strategies, where I'm at now. And Dave wanted to start an RIA. We got in contact and I thought, hey, this is great. Here's a guy that came from the insurance side of the business. He understands how important income is to retirees and their portfolios. So it's probably been 10 years now. So that's what led me to Sound Income Strategies and the firm. We have about 100 advisors now. We start off with just, one, I think day one, and we've grown to over 100 different advisors, from around 30 million day one to we're about $3.8 billion today. That's all organic growth. We've been very fortunate. That hasn't been buying any books of business. So, and that's kind of been our niche to focus on income. We have equity and we have growth strategies as well, obviously. But most of our clients are near retirement or in retirement. So that's kind of our thing.
It makes, I definitely want to talk about more the firm and your experience with building fixed income strategies. Before we kind of go there, what do you like to do, Eric? When you're not working, when you're not, I always like to know, the things that you like to do outside the office.
Yeah. Well, my wife says I'm always working. So I need to work on the work-life balance a little more. Living in South Florida, being based here, it's great. I grew up in the Midwest. So now the fact that I've got palm trees and the beach down the street, so we spend a lot of time with friends and family. probably have kids here before too long, before I get too old. But just enjoying the lifestyle down here.
Yeah, that's great. I'm envious. I'm still in the Northeast in Pittsburgh. I'm not as harsh as a Chicago winter, but
Yeah.
still aren't the best. So, you talked a little bit about sound income strategies as a firm. You guys are, a pretty large RIA with 100 advisors. How would you describe the core investment philosophy at the firm? Like, what are you guys? I know you're focusing on retirees, but is it, are you really leading? It sounds like with fixed income, and can you just talk about the overall investment philosophy?
Sure. Well, philosophy is pretty easy. It's in our name, income. So, like I said, we have equities, we have growth strategies as well, but our niche is producing cash flow or income for clients. Because, as as clients get older, a lot of them want to lower their risk, and they want to know that their income needs are going to be met. And the best way, in our opinion, to do that, instead of trying to guess the tops and bottoms of the stock market constantly throughout the retirement, is kind of like an insurance company. You're immunizing those liabilities. You're saying, hey, we're going to have these cash outflows in the future. Let's kind of lock in. Let's look to match up those assets with those future liabilities. So, it's kind of similar to an institutional style immunization of saying, all right, here's what your needs are. Here's how we're going to produce that with the lowest risk possible. Hopefully, that's what we're shooting for. And for younger clients that aren't there yet, that's where it's going to be more equity, more growth strategy until they get to a place in the future. And some people, believe it or not, that are young really don't. I found some clients don't want a lot of risk either, even though they've worked so hard. They're like, listen, I don't want to see a 20% decline, and even though I'm not going to need the money next couple of years, I don't want to see that. So we're finding some people that are a lot less risk or adverse that are younger actually kind of like a little more fixed income in their portfolio than otherwise most advisors would probably put in there. But again, it's up to the advisor and the end client what their risk tolerances are and what their needs are. And that kind of obviously determines our asset allocation for them.
Sure. So what led to the launch of FXED? What gap in the market were you guys really aiming to fill with the launch of this product? Because it sounds like you're more of a traditional RIA. I would assume you have some sort of use case for your clients as to why you originally launched it. But given the uniqueness of the product, which we'll talk about, really, could you talk about that gap that you were looking to fill?
Sure. Originally, we were looking, there's a lot of clients would have children with smaller portfolios, maybe 20,000, and we were looking for smaller portfolios, a way to diversify and put our core plus strategy, a similar strategy, into smaller portfolios. Because with bonds, you don't want to have more than you don't want to have a one or two lot in your portfolio. If the client ever left, them trying to sell that, they get very, very poor prices. So it was originally started for smaller portfolios, and we've noticed when we went out in the market to look before, because launching an ETF is pretty expensive and can be time consuming. So we looked in the market and we couldn't find anything like our core plus strategy. So that's when, I spoke to Dave and I said, maybe we should think about launching our own. Not only will that be good for smaller internal clients, but also there's probably a need out there, for investors that might not become direct clients of ours or of our advisors, but this might fill a niche for them. So that's when we launched.
So what gives it that your strategy, the uniqueness? I mean, it looks like you're blending traditional core bond fixed income with other things like BDCs, REITs, preferreds, and some other specialty bond ETFs. So kind of what's the thinking behind that structure and what makes this way of investing in fixed income a little bit more advantageous than just going out and buying, the ag?
Sure. Well, we kind of aim for about 75%, to actual fixed coupon instruments. As you mentioned, we hold BDCs and REITs, which aren't traditional fixed coupon securities, but I wouldn't call them traditional equities either. They pay out 90% of their taxable earnings as dividends to the investor, and therefore they're not doubly taxed like, let's say, traditional common stock or equities. We refer to them as cash flow securities. And so the nice thing about them, like if you remember in 2015, interest rates were pretty low. we were basically at zero, and our advisors were looking for 5% plus type of yields. And I'm like, oh, you want a whole high yield portfolio? Oh, no, we can't take that kind of risk. We want to have, a mix. So I was like, all right, well, I started thinking of securities I've used in the past, and I thought, well, let's build this. Let's add on BDCs, because as you know, they're floating rate loans underlying the BDCs. So we knew interest rates were going to go from zero and up. And so the BDCs have helped as fixed income, fixed coupon securities get hurt as interest rates go up, as the Fed moves up. These BDCs actually bring in more income and can pay out higher dividends, help balancing that loss you might see in the value of a traditional fixed coupon security. And similar to REITs, as long as you're looking for REITs that are adding in their master lease agreements, have step up language, or their rents are based on CPI or some floating rate thereof, that can also over time help out with that. So that was why we kind of added those into a traditional portfolio, because overall, as you know, when we're building these out, we're trying to shoot for building. If you look at BDCs and REITs and sovereign debt versus traditional investment grade bonds, for say, you're looking for BDCs and REITs. They have, they're in the low 50s to mid 50 correlation to investment grade bonds, and the low 60s to mid 60s with sovereign debt. So here's an opportunity where we're adding more yield, and since they're lower correlated, higher risk adjusted return. So we feel that's what's adding value to the portfolio versus just buying, as you put out, as you said, the ag.
Right. So can you talk about how your internal process for kind of evaluating some of these non-core opportunities? I'm sure you have some sort of way of finding, selecting, doing due diligence on them before they're added to the portfolio. Can you talk about that security selection process a little bit?
Sure. For BDCs, management's very important. Speaking to management, finding out their background, really looking at the pipeline of how they're bringing in loans. Are they doing mostly club deals? Are they bringing their own companies into the market and evaluating them? So obviously we're looking at net interest income. We're looking at their non-accruals. Are they growing? Are they managing those well? What's the payback? If there happens to be a loss. We're just looking at the growth of that company. Is their net asset value growing? A lot of people always they'll talk about premiums or discounts to net asset value. And one thing you'll notice is the companies that are a little bit higher that you're paying a premium for, those tend to stay at premiums, where the discounts, everybody thinks, oh, I'm going to buy a discount and it's going to increase to a premium, and it never does. And people are like, why is it still a discount? It's because the market is estimating the value of that management. And one nice thing about BDCs and REITs are constantly issuing equity and debt to grow, because obviously their earnings are getting paid out in the form of dividends. So if a BDC is at a premium, guess what? They're issuing stock at a premium, so it's accretive. So that's not a horrible thing. Obviously, we want to see the leverage stay fairly low, and good managers usually keep it pretty low. And then with the REITs, you're dealing with 11, 12 different sectors in equity REITs. I don't go into mortgage REITs because now I'm betting on how good is management playing the trade spread game. In other words, we'll borrow at X and we're going to buy mortgage paper at Y. And you're always trying to guess, is management good at that spread game? Well, with equity REITs, we're buying real property with real cash flows. For me, that's an easier thing to understand and manage. So, we'll look at healthcare REITs, how they came through COVID. What's the government, how's Medicaid, Medicare, how's that going to reimburse them? You're looking at the future of that. You're looking at how they're managing their costs, because costs got a little out of control with skilled nursing facilities and hospitals. So you're looking at how management's controlling that. Are their operators good at managing those facilities or not? Another type of REIT, triple net lease REIT, where the lessee's paying the interest, the upkeep, electricity. So you can understand the spread a little bit better for that management company, for that REIT. How are their tenants? Are they investment grade tenants? Are they big box stores that aren't probably going to go out of business, aren't going to have trouble paying their REIT, their rental, annual rental rates? How long are the terms? So you're kind of looking at all these agreements to try to justify, hey, this REIT's they're not going to have a problem with their dividend anytime soon. And in fact, they'll probably in future years look to increase those dividend yields. So that's what we're looking for, how the management is managing those cash flows in the future.
Yeah, very traditional, almost analyst type approach you guys
Yeah.
are taking. And so when you built this strategy out, how are you thinking about that balance between income generation and then, as you said, the importance of capital preservation? So what comes first, or how do you balance it?
Sure. Well, minimizing risk is great. Whether we like it or not, our global financial system is set up, it's hard coded, if you will, to force us all into some level of risk. Otherwise, inflation, if we just sit on the sidelines of cash, money market CDs, inflation is going to eat away our capital over time. So we have to balance capital preservation with earning a positive return over and above inflation. And while there's definitely times, things like COVID or 2022, worst fixed income market in four decades, worst government U.S. Treasury market ever, there are times where I was like, I'd love to go sit in 30% cash right now and go play golf because this is just going to get bad. But you have to understand, someone's using fixed and using that strategy, they're getting a dividend every 2 weeks. So what happens if I have too high of a cash balance and I do not want to cut that dividend? It's better to look at the best companies we can invest in during that time because we need to stay fully invested. And people just have to understand there's going to be some level of downside risk. It's easier for them to manage their portfolio and have them go to cash than me just jump into 30% cash, which they're probably not expecting. And all of a sudden, hey, where's my dividend? It was supposed to hit today. I'm like, oh, well, we'll try to pay it in a couple of weeks or next month. Investors don't want to hear that. That really can throw off portfolio managers, investors. So, capital preservation is key. It's important, but we can't always go sit on the bench, and hide cash. We have to just pick the best companies and try to find other ways to manage, that volatility.
Sure. So how are you determining, when to adjust the mix between investment grade and some of this high yield exposure? Is that on a weekly basis, a monthly basis, a quarterly basis? Is it fully active where you guys are doing it on the fly? Like, can you kind of talk about when you're adjusting that mix and what's driving that decision?
Yeah, I know a lot of funds will look to do certain calendar rebalances. That's not how we manage in fixed income, because fixed income, it's not like, if I'm an equity manager and I've got a lot of NVIDIA, all of a sudden it's up huge. Now I've got to rebalance because I don't want to get too overweight. Well, with fixed income, it kind of, you're not going to get negative yields. So I let the market kind of determine our mix, like the mix between investment grade or high yield bonds. So for instance, when the market turns risk off and spreads start to widen out, I might look a little bit more at high yield and saying, hey, these yields are a little too wide. These are good. Some of these we're looking at are good credits. We're going to get paid over time to add these. And if investment grade gets too wide, then we look at investment grade names. But we also consider the overall level of yields. If U.S. Treasury yields are pretty high, as they had been in the last year and a half, all else equal, and spreads really aren't moving too much or pushing U.S. investment grade or high yield out of whack, we might just look at the overall yield and say, hey, you know what? I can add investment grade names, quality names, low risk, and the overall yield's pretty healthy. So I'm just going to look to start adding more investment grade at that time.
Yeah, no, it makes sense. And you kind of answered the question there a little bit for me, but what advantages kind of does FXED's active management approach that you guys are taking provide over just, again, back to, I don't mean to pick on the ag, but just that's how a lot of RIAs kind of put their 60/40s together. It's, they don't care about the fixed income side. They're basically using it as a risk off bucket.
Yeah.
And so can you talk about the advantages? I'm sure there are many of actively doing it the way that you're doing it.
Sure. Well, adding alpha in equity has gotten very hard over the years. Equity markets are extremely efficient. And that's why you don't see too many managers year after year beat the index. With fixed income, it's a little bit easier. You can still add alpha. Like I said, I used the example before, NVIDIA. If a manager is underweight NVIDIA or Mag 7 or AI names, they're going to clearly underperform. And if they get too heavy in that, thinking they're going to outperform, the market turns, now they're underperforming. So there's a constant zigging and zagging with equity. With fixed income, like I said, if a company's earning out earns their, let's say they're a nickel over expected earnings for the quarter. It's not like their bonds are going to rally 10, 20 points. So it's a little more stable in fixed income. So something like the ag, which has to be heavily invested in agencies and U.S. Treasury debt. Now the ag's done for the first 6 months of this year. The ag's done fairly well. It's performed very well. But the problem is once that settles down, once interest rates, as people say, maybe the Fed isn't going to move as much as we thought, and that settles down, and then you get some more tariff news as we've had come out recently, like Trump says he's not going to back down this time. And if that's the case, you start to see Treasury yields widen, or Treasury start to sell off a little bit because we're like, well, maybe we've got some more headwinds coming. Well, with fixed income, with a non-traditional like fixed, not only do we have those other asset classes, but we can zig and zag more. I can say, you know what, now's the time to put on more high yield, where a manager in the ag or managing towards the ag or an index like that, they have to focus on kind of matching that aggregate. So they've got good bonds and they've got bad bonds. Well, an active manager like us, we can say, you know what, let's add more weight to the good bonds and let's try to avoid altogether the bad bonds. So over time, we should outperform.
So if you're kind of talking to an advisor or a client with an already diversified model portfolio, they've got fixed income exposure in there, where does FXED kind of fit in an overall diversified portfolio? Is it going to be your core fixed income exposure, or how do you see it?
Yeah, well, it's you have to consider the investor's target rate of return or income need. What's that need, and back into their allocation they need from fixed income investments, given their stated yield. So the advisor is going to have to sit down with the investor, figure that out. And, if they can reach their target return, obviously with less weight to fixed versus eating up more capital going into a ag-like or passive fixed income fund, obviously they could buy less of fixed and then take that difference and then either invest it in the risk-free rate, potentially lowering, risk further, or maybe potentially using some of that extra capital for growth.
Yeah. So when you're talking, it sounds like your firm talks to like a lot of retirees. What role do you see this ETF in particular playing in their portfolios? I mean, you kind of just answered it. You're going to back into it. So It's really, at the end of the day, how much income do they need type question. Is that right?
Yeah. We're not competing versus certainly a growth equity or even the S&P. What we're trying to say is, all right, if this client has a target return, let's say their need is 6%. Well, if they were to pick up the ag or a traditional investment grade bond fund, they're not going to get 6% yield. I forget what the ag is yielding right now, pretty low. I want to say the twos, I forget. That's how much I follow it now because we're focused on a little more growth than that. But that's that. A lot of those traditional funds aren't going to meet that need. But with something like fixed, where we're right now we're in the upper sixes, is what we're projecting. So if we can yield 6.8, 6.9, and the majority of that return is coming from income, and we're meeting that need, I think it's better for them to put it in something like ours than eating up a bunch of capital, and then hoping. Then what happens with the 60-40 type portfolio, the managers or the investors, they've got to go after growth and really time that well to make up for that loss of yield in the ag or a traditional fixed income, ETF. But when they're going into actively managed or something like fixed, that's trying to goose those yields and also lower the overall risk-adjusted return, that's where we think we're adding value for them and freeing up some capital that they can use for even lower risk, or saying, let's pick up a little of the Magnificent Seven or a few AI stocks to enhance the overall portfolio.
Well, I mean, Eric, we're not too far from the period in time where the only place to get income was in equities. The amount of excess risk retirees were having to take in that, around 2000 area, year 2000, 2020 area, not 2000, 2020 area, where yields were basically zero. And a lot of clients that we talked to and a lot of advisors were like, the only place we can get income is in, quality dividend paying equities, and it's excess risk that retirees just didn't want to take. So a product like FXED, I feel like is a good product for people who are looking for yield now that rates are a little bit higher. Anything over 6 is super healthy. And so I think you guys are going to have a lot of success. So before I let you go, I always need to ask, where can people learn more about your firm? Where can they find information about this ETF? And as well, you have another one, am I right?
Yeah, we have our on our equity side, we have another one, DIVVY, which is a high dividend paying equity strategy, value, blue chip type of companies. A lot, our strategy is a lot more boring than, going into, the growth equities and AI, which is pretty hot right now. But anyone that wants to find out more about our firm or our funds can go to our website, soundincomestrategies.com. We have our fact sheets on all of our strategies there, and access to all of our advisors across the country if they want to talk to one of our advisors directly. If they don't want to call the headquarters here in Florida. Some people like to do that, and they want to get out of the snow and ice and come down, have a good excuse.
Well, Eric, again, thanks so much thank you for spending some time with me. I appreciate it. Good luck as you guys, continue to grow and expand, this particular product.
Thank you for having me.
Sure.